All right. In this video, we're going to start looking at the demand and supply for in foreign exchange markets. Now, it's going to look a little bit like the market demand and supply we did back at the beginning of the semester. It's basically the same idea. The only difference is the price is in terms of another currency. And we're going to see that unlike the other one, things are often happening on both the demand and the supply side because the same factors will affect both of them. So let's go ahead and start. So let's suppose we're comparing the US dollar. We're going to compare the US dollar and the Chinese yuan. Just to make things simpler, I'm going to call the Chinese yuan the RMB because that's the Chinese name of it is RMB. That's a short way to refer to it. Okay, so on this side we're going to have the supply and demand. We're going to have the market for here. We're going to look at this as the US dollar. So this is and this is going to be basically how much does one US dollar buy. So over here, this is going to be the RMB per US dollar. Okay, and then this is going to be the quantity of dollars. So that's the price. How many RMB do you get per dollar? Or do you have to give up to get $1? We can think of it that way. And then this is going to be quantity of dollars traded. Okay, before RMB. Okay, so we have our supply and demand here. We can just kind of draw them however. So that's our demand. So those are people who want dollars. The less they have to pay, the more dollars they're willing to buy. That's what the downward slope means. And then here's our supply. These are people who want to sell dollars. Okay, so these want to buy dollars. They have dollars. They want to buy dollars. They don't have dollars. And these ones want to sell dollars. Okay, in this market. Okay, this is the idea. And so supply is upward sloping because the more RMB that you'll give them, the more dollars they become willing to sell, right? Some people weren't willing to sell their dollars, but if you give them more RMB, then now they're willing to sell. Okay, so this gives us our idea. And then these two determine an exchange rate. So these two determine an exchange rate and a quantity. Okay, so let's suppose the exchange rate is 6.66. So what does that mean? Well, that means $1 costs 6.66 RMB. Okay, and that's actually not that far off from the current exchange rate, which I think is like 6.8 something. And then, so let's see what that looks like on this other side. Okay, so let's see what this looks like on the other side. So the market we've drawn is the typical way that a lot of people think about exchange rates. They would typically just think about them this way. So we'll kind of think of them in terms of the US dollar, but we could also write this the other way. So we can think of it out as the market for Chinese yuan. So in this case, the demand is people who want to buy Chinese yuan, the RMB, and the supply is people who want to sell it, right? So again, we're thinking about it in terms of dollars. So we're thinking of, well, US dollars per RMB. That's how we express the price. So how much does RMB cost? Well, you're thinking, well, how much US dollars is it per RMB? And then this down here will be the quantity of RMB, traded for the US dollars. Okay, this is the idea. And these two things are going to be directly related to each other. Okay, so now in here our demand is they are buying RMB, and these ones want to sell it. They're selling. They're selling RMB. Okay, so. And of course, the more dollars you'll give them, the more that the sellers will sell, and the more dollars they have to pay, the less people would like to buy RMB, right? So if you can get a whole bunch for $1, then people are more willing to buy. And if $1 doesn't buy you very much, right, you have to pay a lot, right? You have to pay a lot to get one Chinese yuan, then people will want to buy less of it. That's what the downward sloping and the upward sloping demand tell you. And so this then determines an exchange rate, and this exchange rate is going to be the same. It's the inverse of the other one. So over here it's 0.15, right? And then quantity. We get some quantity, and we get some quantity. Okay, these are not the same quantity. This is the quantity of RMB, and this is the quantity of dollars that is traded. Okay, but so anyways, and so what this 0.15 is, well, this is just the inverse of the other, and so that's that. Well, we get 1 RMB costs 15 cents US. Okay, so that's the meaning of these two, and they're equivalent. So when so you can really think of an exchange market either way. You can think of it as the U.S. dollar, or you can think of it as the other currency you're looking at. But they're equivalent. They're the same thing. If you take this 1 RMB costing 15 cents, you'll find out it's the same thing as $1 costing 6.66 RMB. Okay, so we're going to be using both of these as we go through and look at some examples. So the question we're going to ask next, and I'll put this into another video, we're going to ask, well, what's going to cause this exchange rate to change?